Hello, this is Sunko, the Korean bro. Today's 2024, January 31st. Let's read today's articles, okay? Yes, Microsoft is a star AI stock, but this is what really powered Sol's second quarter results. One part of its collection of product and services saw its revenue rise by 30%. This helped drive the tech giant's overall top line nearly 20% higher. Hmm. No cloudy skies with the cloud. Even if AI is still a relatively young technology, wasn't a mighty driver of Microsoft growth for the quarter. It still made a difference. The company said it now has about 53,000 clients for Azure AI. Okay. Royalty income and Fastenal. Kimberly Clark, Unilever's growing business and low payout ratio make it probable that more dividend hikes are to come. PepsiCo. Canoe stock. Meta. Alphabet here. Okay. High quality AI power stash could generate significant returns in the long run. The Nasdaq Composite posted return of 43.4% in 2023, one of the few times the index has seen such impressive single year growth. A good portion of this growth can be attributed to the phenomenal performance of artificial intelligence powered technology stocks that are a part of the index. Artificial intelligence technologies are fast becoming integral parts of our daily lives through areas such as autonomous driving, claims processing, and telehealth. It's safe to say that AI is no passing fad, but a theme that will remain relevant for the upcoming decade. Coupled with increasing optimism for U.S. economy and cooling inflation in 2024, many AI stocks may again rally in 2024. Alphabet, Google, Meta platforms. The company behind Google, YouTube, Android, and Chrome accounts for nearly 39% of the global digital advertising market. Notably, in the third quarter, the company saw a surge in advertising revenue, particularly from the retail sector on Google and from direct and brand response advertising on YouTube. Moreover, the company is focusing on strengthening its core business in multiple ways. Its flashy Google search business accounted for a 91.6% share of the global search engine market in 2023, declined from its 92.6% share in 2022. Although that market share decline is attributable to competition from Microsoft generated AI enhanced Bing search engine, Google remains a force to reckon with the search space. YouTube subscription revenue also rose significantly thanks to the rapid expansion of the video sharing platform subscriber base. Alphabet is also working to improve advertiser performance and profitability as well as the user experience on Google search by leveraging generative AI models through its SGE initiative to deliver highly targeted, contextual, and relevant search results. The company has also included its most advanced large language model, Gemini, in SGE. It has also incorporated conversational experiences in Google Ads, introduced updates to AI-powered tools such as Performance Max, and offer new advertising formats and campaign types to further attract new advertisers and reach more users with its platforms. The Google Cloud business rate in revenue of $8.4 billion in the third quarter, up 22% on a year-over-year basis, which focused on allowing clients for hybrid environments and multi-cloud environments. Google Cloud works seamlessly with clients on-premises infrastructure as well as with other public clouds. Today, nearly 60% of the world's largest companies use Google Cloud. plus Google Cloud AI services such as the Vertex AI platform and BigQuery MS Service are also helping clients build, deploy, and scale AI-powered applications rapidly. Based on Alphabet's rapid strides in the AI-driven digital advertising space and the increasing momentum of the Google Cloud business, Alphabet seems like a compelling buy now. Paramount Global. Snowflake. Hmm. Palantir Technologies. Hmm. Okay, let's start reading about Tesla first. Okay. Hmm. Then I was called Tesla's latest earnings a train wreck. He's reached a recommendation to turn the company around. Okay. During Tesla's fourth quarter earnings call, management expressed some views about its AI mission that did not resonate with investors. The company's slowing growth, coupled with the risk associated with its AI development, contributed to a heavy sell-off of the stock. Then, as Wedbush Securities has outlined 10 things Musk could do that he believes could restore faith in Tesla and its leadership. Its fourth quarter and full year results from a deteriorating margins and shrinking cash flow due to a mix of price cuts and demand issues to a not so confident outlook on the company's artificial intelligence projects. It wasn't Tesla's best moment. Ultimately, many investors criticized CEO Elon Musk for the uninspiring report. And one prominent analyst on Wall Street did not hold back or mince his words. The Navajo of Wedbush Securities used the term train wreck to describe the conference call. He doubled down on the stance by releasing a list of 10 action items he suggested Musk and his team could undertake in order to win back investor confidence. With the stock already down over 20% this year, let's dig into what I was suggesting and assess how taking his advice could impact Tesla in the long run. Okay, many of the items on as Wall Street, as these revolve around artificial intelligence. This should not come as a surprise, given the company's hefty investment in autonomous driving. So, indeed, back in October, Musk sparked some excitement among investors when he positioned that AI could make Tesla the most valuable company in the world. Furthermore, with the company periodically releasing videos online showcasing the progress of its other ambitious AI projects, such as its Optimus humanoid robots, it can be hard not to buy into the hype, you know. So Dena is one of my favorite researchers on Wall Street. I have an immense amount of respect for the work he and his team publish. But among his 10 suggestions illustrated above, I'm not aligned with the following: hold an AI day, AI acquisition spree, Mm. Companies are known to produce presentations to help facilitate big announcements. Palantir lead last year to help market its new artificial intelligence platform product, and Apple has historically debuted its new product during live conferences. Tesla, for its part, has hosted smaller, similar events that have garnered excitement around developments such as the Cybertruck. So, AI can be a tangent of Tesla's overall business, but right now I think the company needs to win back investors by showcasing that it's a leading car company and that it's focused on building that business above all else. The developments surrounding AI are exciting. I'm bullish on their long-term potential. But for now, it may be best for Tesla to focus on the car business and get back to strong unit economies. The company can do this if it follows our suggestion of halting its price cuts. While this alone won't turn around the entire picture, it's a good start. Okay, let's see. The near-term future looks green for this automaker. With shares already down over 20% year to date, Tesla has been off to a rocky start. In the new year, the challenges came to a head after the company reported fourth quarter earnings and CEO Elon Musk announced vehicle volume growth will notably lower in 2024. Continuing the worrying trend that plagued the company in 2023. Unfortunately, for investors, Tesla's problems run quite deep and will need a long time to solve. Let's explore some of the reasons why investors should be increasingly cautious with the stock. Electric vehicles still a growth industry. Around the world, governments have been pushing the transition to electric vehicles. The EU wants to phase out all emissions producing cars by 2035, while China wants EV to represent 40% of new car sales by 2030. But while automakers have raced to satisfy government objectives, perhaps too little attention has been given to what consumers actually want, leading to EV supply outstripping demand as margins deteriorate due to excess competition. For Tesla, the problem has become apparent. For most of its history, the company could sell its cars practically as fast as it could produce them, taking advantage of unmet demand in the market. The increasing government promotion of the industry may have introduced too many new rivals, eroding the foundation of Tesla's growth history. Because of its economies of scale and innovative manufacturing techniques, Tesla can still keep its often deeply unprofitable American rivals at bay. But Chinese automaker BYD will be much harder to fight because of its high levels of vertical integration. In Tesla's fourth quarter earnings call, Musk made a stunning claim that Chinese EV firms would demolish rivals without trade barriers. This must suggest Tesla's leadership no longer believes it can compete fair and square in the free market. So here we have artificial intelligence might not save the day. With Tesla's EV leadership no longer so obvious, investors are increasingly turning to its artificial intelligence efforts to power the next leg of growth. So the company is working on a supercomputer called Dojo, designed to handle data generated by its full self-driving program and to help with other initiatives like robotics and computer vision, which could allow machines to perform tasks that previously required humans. Okay, originally, Tesla is EV company, but investors are thinking they may not be focusing on electronic vehicle at this point. So why not turning to its artificial intelligence technology? You know. So according to Morgan Stanley analyst Adam Jonas, these investment could eventually add $500 billion to Tesla's market cap by unlocking new revenue streams like software and technology licensing. It's hard to remain optimistic about Tesla's AI potential when management seems less than convinced. By calling Dojo a long shot, implying a potentially high payoff but a low probability of success. While most believes the opportunity could eventually be worth hundreds of billions if successful, he makes it sound more like a gamble than an imminent growth driver for Tesla. Okay, and plus, in light of this significant uncertainty, Tesla's stock price evaluation has once again become difficult to ignore. With a four price earnings multiple of 56, shares trade a significant premium to the S&P 500 average of 22. Mm. And this is a lot to pay for a company with slowing automotive growth and an uncertain path forward in AI. To be clear, Tesla is still a fantastic business with a long track record of overcoming challenges. But a good company isn't always a good investment. Tesla is adapting to a rapidly changing EV market, and investors can already see the toll that's taking on its growth and profitability. Though it may be tempting, to buy the deep, you may want to wait for a few more quarters of data before considering positioning the stock. So you may as well wait till it comes down to level where you want to buy. It's still a bit expensive because PER currently is 56, um, which is a bit high compared to S&P 500 average. Okay, we have. Let's go see Roku here. Hmm. Roku's gross margin has been a sore spot for a business in recent quarters. They could improve in quarter four. Okay, a lack of profitability has resulted in investors paying less of a premium for Roku stock. By diversifying its product mix, Roku can generate more revenue growth, but that may not help the bottom line. So the stock is still nowhere near the high it reached just a few years ago. Stock has been on a tier of like, as economic conditions have been looking better, the streaming company has benefited from more excitement and bullishness around growth stock. Shares of Roku aren't quite at their 52-week high, but they rallied 60% in just that past 3 months. Can this really continue, or could Roku stock be running out of stream? So, although Roku stock has been doing well of late, in the context of its price sales multiple, its valuation still appears fairly modest. Over the past 5 years, the stock has averaged PS multiple of more than 11. But given the company's struggles with slowing growth and mounting losses, investors have clearly been taking a more cautious approach, no longer willing to pay such a premium for a business. Roku's operation remains risky as the company has begun producing its own TVs. While the new product may still stimulate top line growth, they won't necessarily translate into higher profits. Roku has typically incurred gross losses on its hardware sales, while the company's platform picks up the slack. So, until Roku can prove that it has a path to sustainable profitability, the streaming litter may not be able to command the same market premium as it did in the past. This is that I'd put on the watch list rather than buy because I'm not convinced it can keep up its recent momentum, especially if the upcoming earnings report proves underwhelming. So this guy author is not certain about buying this company. And you just reported positive adjusted EBITDA. The growth of ad-based streaming will favor the platform. The stock looks well priced for its growth potential. Okay, while Roku could 10 times, it's not easy for any stat to increase tenfold, but Roku has a chance to do it. The video entertainment market is massive. Streaming still makes up less than half of video consumption in the US, and considerably less in other countries. Market share will continue to shift from linear TV to streaming. The stock is all small and well priced enough to give it room to appreciate by 10 times. First, its market cap is $13 billion, and reaching a market cap of $130 billion in the next decade wouldn't seem unreasonable for a leading streaming distribution platform, especially if Roku can maintain its user growth rate. So the company isn't currently profitable, but it trades at a price sales ratio of under 4, which is modest enough to give the stock upside potential as well. If Roku can grow its revenue by 20% over the next decade, which seems achievable given the shift from a linear to streaming and the embrace of ad-based streaming, that would take its revenue up by close to 7 times, from a $3.45 billion to $21.4 billion. If its price sales multiple expands to 6, which could easily happen as the business is likely to profitable by then, the stock price will have multiplied by 10 times. At a 10% profit margin, Roku stock would then trade at a price to earnings ratio of around 60, lofty but not unusual for a fast growing market, darling. So the opportunity is there if Roku executes. We'll need to keep growing new users, taking market share, and building ad inventory with the help of its streaming partners. It looks like one of the best prospects for 10 times growth over the next decade. Okay, today this is it. 12 night, and see you and everybody, and have a good night. Okay, bye bye.